Good evening, viewers. Welcome to episode 7 of Filter Coffee with Context. I'm Shubhida Patil and I'm here to represent the views of Karthik Junagadla, who is RA, and that of Contest Research Team. Contest Research is here to guide you through some of the significant trends shaping our markets today. We are focusing on the substantial movements by foreign portfolio investors in the Indian equities and their broader implications. In May 2024, the landscape of the Indian market was notably shaped by FPIs withdrawing over 20,000 crores, driven by uncertainties surrounding the Lok Sabha elections and a shift in investment strategies from long-term holding to more speculative and hedging activities. We'll unpack what these shifts mean for the market and explore the factors that could influence future trends. In response to the electoral uncertainties, FPI not only extracted significant capital but also ramped up their speculative positions, adding about 210,000 contracts in index futures. This behavior marks a strategic shift towards a more defensive and speculative posture rather than a sustained investment in the equity market. To contextualize these numbers, we must understand a base effect. Back in 2012, India's market capitalization was roughly 1.3 trillion US dollar. Fast forward to today and it stands at approximately 4.5 trillion US dollar. This growth means that while the absolute numbers of contracts and withdrawals are large, the relative impact on the market is considerably different and less severe than it would have been a decade ago. This analysis reveals that the substantial FPI withdrawals, though significant, do not spell doom for our market. It reflects a mature market's capacity to absorb shocks and maintain stability despite notable foreign outflows. Understanding these withdrawals and their context sets the stage for our next discussion. We'll explore the potential for a rebound in FPI inflows driven by change in global monetary policies, geopolitical developments, and India's growing influence in global indices. These factors could reshape the investment landscape, attracting more foreign capital into our markets. There are multiple indicators suggesting a potential rebound in FPI inflows in India. Let's explore these promising factors that could revitalize investors' interest in our markets. A significant factor that could influence FPI activity is the changing landscape of global monetary policy. The US Federal Reserve could potentially pause or reduce the interest rate hikes. Such a move would lessen the attractiveness of the dollar and shift capital towards higher yielding assets in emerging markets like India. This easing of rates in the developed economies often prompts investors to seek better returns in places with strong economic prospects and higher interest rates. Another crucial element is the global geopolitical environment. A potential easing of tension in key global regions, Eastern Europe and Middle East. A more stable geopolitical climate can encourage investments into the emerging market. Furthermore, India's position in the global market is becoming increasingly significant. Currently, India's weight in the MSCI Emerging Markets Index has climbed to over 18.2% and is projected to increase beyond 20% by mid-2024. This enhancement in weights is not just a numerical increase, it signals India's growing influence and stability as an investment destination. Such prominence typically attracts substantial passive investment flows as global funds allocated to track these indices will naturally increase their holdings of Indian equities. These passive inflows are particularly important because they tend to be long-term and stable. Providing a solid foundation of foreign capital, India's market is not only attracting these flows due to its index weight but also because of its robust economic fundamentals, including strong GDP growth, improving regulatory environment, and a vibrant corporate sector that continues to post impressive earnings and growth. In summary, While the immediate past has shown some turbulence with FPI withdrawals, the broader outlook based on global monetary trends, geopolitical stability, and India's strategic position in global indices offers a compelling case for optimism. This factor collectively herald a potential upstick in FPI inflows, reinforcing India's allure as a prime destination for global investors. Turning our attention to foreign institutional investors, we see that FIIs have primarily engaged as speculators and hedgers, particularly in the derivative market. Despite rolling over long positions worth INR 24,200 crores to May expiry, their net loan exposure has adjusted to approximately 13 to 15,000 crores. Contest Research Analysis highlights that while FIIs are technically long in select FNO stocks, they are net sellers in both the cash and index future markets. This behavior reinforces the contest's view that FIIs are largely speculating in the derivative markets rather than investing in the cash segments. With Nifty currently around the 22,600 levels and contest maintains support range between 22,000 to 21,000, the options data suggests the potential for a 500-point intraday move in either direction. Such a move could trigger significant volatility, impacting option writers who may struggle to adjust their positions quickly. It's important to note that there is no shift in contest stance from previous episodes. Contest continues to prefer micro cap, small cap, and mid cap over large caps, particularly focusing on sectors like finance, that is non-banks, realty, mobility, consumer durables, and information technology, which Contest believes are well poised to thrive under current market conditions. Thank you for joining us on today's episode of Filter Coffee with Contest. We hope this discussion has provided you with a clearer understanding of the current market dynamics and of what the future may hold. Please like, subscribe, and share your thoughts in the comments below. Stay informed and strategically poised in these changing times. Until next time, keep analyzing and keep sipping your favorite coffee. For more insights and updates, follow us on our social media channels. Here's smart investing and thoughtful analysis.